From airlines to big banks, earnings season kicked off with a big bang last week, but a choppy earnings picture and a varied economic data signal sent from consumers on the state of the economy. It was all mixed. That's today's morning brief. Sozzi, you wrote this one, so I'll kick it on over to you.
Did I write it, or is it some AI chatbot, Brad?
Oh.
Yeah, that's a question I think to be asking this morning. But look, there's a lot of mixed signals here. Of course, you can read this on the Yahoo Finance homepage. I encourage you to do that and share with everybody you know. So there are some positive signs in consumer land, really. And I was inspired by your interview with Delta CEO Ed Bastian calling out very strong forward bookings. Despite their earnings miss, the company looks to be set up for a strong spring and summer travel season. Next up, you have Express out there spending $75 million to go buy bonobos. I don't think if CEO Tim Baxter over at Express saw a really nasty or bad recession over the 6 months, he is not spending $75 million of investor cash to go buy a higher-end luxury brand in bonobos. Now, while those are the positives, there are, in fact, negatives here. You had a second consecutive poor read on retail sales, and there I am with the Grinch, really capturing everything that I'm thinking here and how bad the situation may, in fact, be. So bad March retail sales report, again, weakness across the board. You listen to the bank earnings calls. They're calling out slowing growth in debit and credit card spending. Makes sense to me, given how far interest rates have risen. And then CarMax earnings, those results not good in terms of sales and profits, both down in large part because of higher interest rates. I suspect you will hear that this week when AutoNation reports. A lot of mixed signs, very confusing time for investors, but if you look through the prism of some of these retail stocks, Macy's down 14% year to date. So maybe a lot of investors aren't surprised by a lot of the bad things in this data. And you can see the declines right there.
What could be even more interesting is when we continue to get an update, and I believe it's the New York Fed that's going to publish this update, is on the credit card and particularly on the debt side of the equation too for consumers, because if that's one thing that the Fed banks are also looking across, it's really about how much consumers are leaning more into credit to make some of these purchases on the other side where they're not sure if they can deploy immediate cash that they have and still feel comfortable about their savings, about where they still have to manage or pay down other debt. And so that considered can give you, even as we're hearing about the health of the consumer right now and saying, for some of the CEOs of banks saying that the consumer is resilient, that health is still going to be hingent on going forward from here, how healthy they are coming out of what is this extremely talked about, yet I think, as I was writing even that Delta interview up last week, a very unpunctual recession, as many economists would probably call it.
You know, it was interesting, Brad. I went to Target over the weekend. I was picking up some face products, as I normally do, and I saw at least 15 baskets of unsold apparel right by the fitting room section, just in a baskets. There are just 15 baskets in this store, really epitomizing, I think, everything we're seeing in terms of retail sales. Consumers still paying more for services, but not out there really buying stuff on credit cards.
Yeah.